Great. Now, ladies and gentlemen, remember, we have what we call the traditional variances. Traditional variances, right? And then we have this type of variances. So assuming we have our original budget here. Right? You see, things change very fast. We may have done a very good budget at the beginning of the year, and then in between the year, we have Corona pandemic, in this case, striking the nation, striking the world. So then what that would mean, if, for example, we had budgeted to pay our lecturers, say, at 1,000 bob per hour, especially the part-time lecturers. With the COVID pandemic, part-time lecturers were not getting anything. So in this case, it meant that we should have gone back to our budget and revised the budget. We should have gone back to the budget and done what you revised. It's important whenever you see that the budgetary figures that you have, whenever they are not quite reflective of what is on the ground, you are always allowed to do what you have to revise. So then come and give us here what we call the revised what here, give us what we call the revised budget. The revised budget. Give us what we call the revised budget there. And then now, ladies and gentlemen, of course, at the end of the day, we shall be having what we call the actual results. The actual results. Those three things are very important for me to be able to define what planning and operational variances are. Now, ladies and gentlemen, listen and listen to me very well. Whenever we talk of the traditional or conventional variances, we normally compare between what and what? Original stroke actual. When we talk of conventional or traditional variances, we don't bring in any issue to do with what here, the revised. We don't revise the budget whenever we are looking at the traditional. So the two, when you compare the two, you talk of the traditional variances. You talk of the traditional variances like that. You talk of the traditional variances. You talk of the traditional variances. Now down here is now where we have the modern type of variances. And the modern type of variances, you need to break them down into two. How do we break them down? We have these variances that we compute by comparing budgets. Revised budget vis-a-vis what here? Original budget. So whenever you make that comparison, whenever you're getting that variation between the original and the revised, these one now here will be called the planning variance, because budgets are tools of planning. So this is the planning variance. And then now, ladies and gentlemen, of course, at the end of the day, you'll be looking at the revised budget vis-a-vis the actual during operations. During operations, we'll be comparing the revised versus what here? Actual. So this is what we call the operational variance. This is what we call the operational variance. This is what we call the operational variance. So have you been able to draw, first of all, this? Have you drawn this? Have you drawn this? Have you drawn this? Have you drawn this? Jamie, Margaret Kimani, Evelyn, ML sijui nani huyu, hata JS sijui nani, but very active. Thank you so much. So they have been able to draw. So in short, in summary, when we talk of planning variance, we shall be comparing between original budget versus revised budget. This is my summary. Versus revised budget. Any planning variance. Very important for me. And then I have number 2, during operations, the operational variance. The operational variance, I'll be comparing two things. I'll be looking at the revised budget. I'll be looking at the revised budget versus the actual versus the actual what year results versus the actual results. So operational. And then now lastly, we have the traditional variances, the traditional, the archaic, the conventional, the ancient variance. We are comparing between original versus who versus actual like that. So is there somebody who has been able to write this? These are very important summary. The way ACCS summarizes this, it doesn't want us to write so much in terms of notes. No, thank you so much. So now I can grab this, and then now we go to a question. So before I do this question, I would want to know whether you guys got some time. Did you get some time to watch my video that I sent last time when I was not able to come for class? I sent one video, 1 hour video, 1 hour long video. You get some time to have a look at it. Is there anybody who created some time to look at it? Yeah, just be honest. Here we are mature people, we don't cheat. Even if you have not watched it, so what? I just want to know, is there anybody who created time to watch it? Watch it later today, great. Wasn't opening, what do you mean? Wow. Maybe on your phone, because those things normally open. Yes, I watched, ML watched, I can tell you it opens. So the ones who never watched, it will be very important for you to watch that one for us to have a very good flow of the topic. So it's like we have missed something, but I'll try to go a bit slow for us to catch up. But most importantly, don't miss on that video, especially one that has got a title there, operating statement. There is one which has got a good title of reconciliation statement or operating statement. Very important. Great. Now, ladies and gentlemen, here we are. So they have given us example one, and I'll be able to tell really that this is a planning operational variance question. I'll be able to tell. So you can see here, example 1, original budget is given. Standard cost of materials, 10 kgs at 5 per kg. Budgeted production, 10,000 units. Then now we have actual results. We have production there, and then we have materials. Then they are telling us that since preparation of the budget, the price per kilogram has changed to 4.85 and the usage to 9.5 kilogram per unit. So they want us to calculate the expenditure and the usage variances and then analyze each into planning and operational variances. Hey, this one I'll get all the marks. This one I'll get all the marks. Just a moment, my camera has gone off. So I'll be able to get all the marks really here without even knowing what I'm doing. The first thing that I'll do, I'll tabulate my data and arrange it this way. I'll put here, I'll come and tabulate this data and put it this way. So here we have the original budget. Then we have in this case here, the revised budget. I'll have to tabulate it like this. Then now here we have the actual results. I'm just copying everything the way it has been given. So you can see original, we have materials. Original materials, we have 10 kgs at 5. 10 kgs at 5, which is 50. 10 kgs at 5, which is 50. And then we have budgeted quantity. Budgeted production. So budgeted production in this case here, is 10,000 units. Thank you. And then look at the revised. Look at this sentence down here, the revised. Since preparing of the budget, the price per kilogram has changed to 4.85 and usage is now at 9.5 per unit. So in this case here, in terms of material again, we are told the usage is 9.5 kgs at 4.85. Right. And then now we have actual results. So the actual results, what do we have here? So the actual results, what do we have here? Actual results, we have a production, the actual production. The actual production is 11,000 units. And then we are told here, materials used, the actual quantity of materials. The actual quantity of materials is 108,900 kilograms. 108,900 kilograms, 900 kilograms at 4.75. Great. So that is the first thing that you do. First of all, you put down the question like that. You organize it like that. So we have all materials originally 10 kilograms at 5. You don't even have to write this. This is irrelevant. And then revised budget, they told us the consumption is 9.5 kilograms at 4.85. And then the actual results, we have actual production. We produced 11,000 units. And then the materials we actually consumed were 108,900 kilograms at 4.75. So first of all, have we finished putting down this information in these columns like that? Have we finished writing the information down like that? Have we finished? 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 Yes or no? They aren't talking to me. Have they finished writing like that? Great. Fatima, karibu sana. Fatima, what you are doing, there is a book that I've sent to your group, WhatsApp group, and we are doing example number 1, which is on page number 8, regarding planning and operation of variances. The only thing that we have explained while you are away is quite an easy one. We've said that in life, normally, you will have your budget set. And then without notice, you'll get things coming up. For example, a very strong competitor may make you to revise your prices. So we have our revised budget, and then we have, of course, our actual results. So when we compare this budget vis-a-vis this, we talk of planning variances. When we subtract the two, planning variances, and then these versus these, we talk of operational variances. Like that. Now, these are material variances. So I will begin with the formula of material price variance. Could you kindly remind Mwalimu, what is the formula of material price variance? Is there somebody who can try the formula of material price variance? Material price variance. They are not talking to me. They are not talking to me. Material price variance formula equals O. Thank you so much. So they're telling me that material price variance, this is the difference between two prices. This is the difference between how many prices? Two prices. So the two prices here are standard price, what we thought would have really bought these materials at. We call this one here the standard price, minus the actual price. You know, variance means you're subtracting. Variance means you're subtracting. Multiplied outside here with what here? Outside here multiplied with the actual quantity that was done what year that was purchased, multiplied by the actual quantity that was purchased. Then with your permission, I would want to calculate the operational material price variance. The operational material price variance. I would want to calculate this first. The operational material, this one here, operational material price variance. So when I'm getting, ladies and gentlemen, I would want you to listen to me very well. When I'm getting the operational material variance and the operations, I'm comparing the revised vis-a-vis what here, the actual. I'm comparing the revised vis-a-vis the actual. So it means that this price has to be the revised standard price. This one here has to be the revised standard price. I normally start with operations because they are very easy to calculate. So the revised standard price, is there somebody who is able to see the revised standard price of materials? From this column, is there anybody who is able to see the revised standard price of materials? The revised standard price of materials. Yeah, the revised standard price of materials is this. It's 4.85. Thank you very much. So this is 4.85. Thank you very much. Now throw your eyes to the actual results and give me the actual price. Remember that this is standard price per unit. Also, this has to be actual price per unit. Is there anybody who is able to see the actual price per unit? Actual price per unit from the actual results. From the actual results, is there anybody who is able to see the actual? Yes, the actual price of, remember these are materials. The actual price of materials here is 4.85. Thank you very much. So 4.75, sorry, 4.75. And then now outside here, we shall have the actual quantity that was purchased. Actual, not of units that we sold or we produced, it is material variance. So this is the actual quantity of material that was purchased. Are you able to see this actual quantity of material that was purchased? Somebody? Are you able to see the actual quantity of material that was purchased? Yeah. No. You know, 11K is what we actually produced. It cannot be booked into materials. The materials here that we actually purchased and used were 108, 900 Gemi. 900 Gemi, angalia hiyo. Because it's not, you know, it would have been 11,000 if we spoke of actual quantity produced. Right? This is the actual quantity of materials that was done, what that was purchased. And the actual quantity of materials here purchased was 108, 900. This was 108, 900, like that. So please give me this answer. If negative, it's adverse. If positive, it's favorable. Please give me this answer here. So open brackets, 4.85 minus 4.75 gives me what figure, ladies and gentlemen, here? 10,890 positive, favorable. So 10,890 favorable, like that. 10,890 favorable, like that. So all of us, I don't know whether we are able to get this material price variance, all of us. Operational, material price variance, operational. All of us, are we able to get this material price variance, operational? You say open brackets, 4.85 minus 4.75, you close, times 10,890. Yes, thank you very much. So who is the natural partner of material price variance? When you're talking of materials, there will always be two variances you have to think of. So when I finish with material price, I should be able to reckon the fact that the natural partner of material price variance is material usage variance. Material usage variance. So is there somebody who can remind us the usage variance? You see, usage variance is a quantity variance. We are looking at how efficient we were in terms of our raw materials. So you're looking at the very beginning, we must, of course, have had a plan. We must have had a plan of how many units we would have used. So in this case, we are looking at the difference between standard quantity minus actual quantity, like that. So that difference between standard quantity minus actual quantity, right? Thank you very much, JS. So it is standard quantity minus actual quantity. And then outside here, we must monetize. Outside here, we'll come and talk of what here standard price. Outside here, we'll come and talk of standard price. So please write these things in full. This is standard quantity of materials for actual production. For actual production. This is the actual quantity of materials used. This is standard price per kilogram. Standard price of material. Remember, it's material. Don't bring price of units sold. It is standard price of materials. So let's go very slowly here. Remember, the one we are computing at the moment is known as what here? Is known as operational. The one we are computing at the moment is known as operational. So then go to the operational, go to the revised. So it means this has to be revised. This must be the revised standard quantity. Because during operations, we are comparing revised versus what here? Versus actual. So the revised standard quantity, are you able to see the revised standard quantity? Are you able to see the revised standard quantity? You can give me the figure. Because when I look at this revised budget, I know these are dollars, this is money. This is the quantity. So the revised standard quantity is, they're getting 10 kilograms. They've gone back here to the original. Thank you for trying. Jemima has jumped to 11,000. We shall overcome. Remember, revised. Where is the revised? See here. This is standard quantity. This is standard price. So this is the revised standard quantity. This is the revised standard price. So the revised standard quantity here is 9.5. But some of you are very clever because perhaps this is why you are confusing. You know, it's supposed to be standard quantity for actual number of units that were produced. So it's supposed always to be multiplied with the actual production. It is standard revised quantity, 9.5, but for actual. So I must come here and multiply this with 11,000. With 11,000. 11,000 is what we actually produced. Great. And then we have minus the actual quantity that was used. We have minus the actual quantity of raw materials, that was used. So they're giving me this figure as 108,900. This figure here. I don't know whether all of us are able to see this one. 108,900. 108,900 is the actual quantity of materials that was done, that was used. And then now we go to the outside. Outside here, they want us to give them the standard price per kilogram. So the standard price per kilogram, is there somebody who is able to guess and give us the figure? The standard price per kilogram, is there anybody who is able to guess and give us the figure? 4.85. Jamie is saying 10. Jamie price, thank you very much for trying, but Jamie price can never be kilograms. Right. You're correct. You are taught and told that normally when it comes to this planning operational variances, the main thing is in this bracket. This is where we have the variance. But outside the bracket, we must either get things from the original or from the actual. Outside the bracket here, there is nothing revised which goes there. Right? Ladies and gentlemen, remember, I'm repeating again, thanks JS. I'm repeating again that outside here, when they mention the standard price, even if you're getting operational values, you can't say standard price is 4.85 because outside we will never get any parameter from the middle here going up. So when they talk of standard price, they are making a reference to the original budget when it's outside here. So in this case here, I need to come and say times what here? Times 5 there, times 5 there. So could you kindly give me the material usage, operational variance? Please give me a figure. So 9.5 times 11,000 minus 10, 8,900, you close. Whatever you get times 5. If the figure you get is positive, you say favorable. If the figure you get is positive, you say favorable. And then you compare notes. So what do we have here, somebody? So we have 22,000 adverse. So we have 22,000 adverse, 22,000 adverse, 22,000 negative according to Jenny. I don't know whether it's all of us who are able to get this figure. Is it all of us or it's only Jenny? Thank you very much. Also, Jemima has been able to get the same. So, ladies and gentlemen, remember this book has got answers at the back. This book has got answers at the back. What you need to know is basically the chapter number. It's chapter 14 and the question number. Chapter 14 and the question number is example 1, and then you'll be able to go to chapter 14. Like now, these are very important for your exam. Original flex, very important, very good things. So this is a you can see the operational variance. They're getting what here? 22,000 adverse. They're getting 22,000 adverse. Very easy. Don't adopt their method. Our method is always better. Their method, you only use it for purpose of what here? Just comparing your answers, only comparing your answers, just that. Thank you so much. How about planning variance? Are you able to remind us what we got for our planning variance? Is there somebody who can confirm what we got for our planning variance? We haven't yet done. We haven't yet done the planning. We did. There is one that we have done here. They're organizing the answers badly. No worries. Let us just finish the entire thing. Now, ladies and gentlemen, from there, what I will do, it's page 50 something. Great. So now we go to the planning variances. Let's go to the planning variances. Planning variances, if you remind Mwalimu here, planning variances, we are comparing between two things. For planning variances, we are comparing between who and who. Planning variances. So now we are through with the operational variances. We are mentioning there that the next thing that we shall do is to come and calculate the planning variances. So planning variances, we know what we are comparing between to get planning variances, ladies and gentlemen. These are the planning variances. These ones here. These are the planning. So no worries at all. What you will do, my friends, if it is material, we know that material has got two variances, material price variance and the material usage variance. So first of all, I'll come and write my usual formula the way it is. My material price variance, the normal one. We know this is the difference between standard price minus actual price. And then we have outside here, actual quantity was purchased. Like that. But now for sure, I know that when they come and mention the word planning here, when they mention the word planning there, I know that whatever is in brackets, I'm comparing between two things. Whatever that is in bracket, this will be the reversed standard price, not reversed, but original, the very original standard price. And now this will be the revised price. Outside here remains. So like now here, the original standard price per kg, you guys had given me a figure of 5. Minus the revised price. The revised price, you guys gave me 4.85. 4.85 multiplied by the actual quantity of materials that was purchased, which is 108,900. 108,900. Could you kindly give me the answer here? Could you kindly give me the answer here? So wasikusitue na kizungu mingi bure. Ni ushike tu concept. Ukishashika concept ni hivyo. You can never go wrong. Ukishashika concept ni hivyo. You can never go wrong. So JS anasema ni 163, 35. Jamie is confirming 163, 35 favorable. It's positive. 163, 35 favorable. Thank you very much. Thank you very much. Any material price variance planning. Haya, mimi nataka nikupatie dakika mbili jameni, only 2 minutes. Try to see whether you can now get the other component, which is material usage variance for planning. Let me see whether you can get this one here, material usage variance planning. Material usage variance planning. So remember that usage variance, I'll even write for you the formula. Usage variance, we are looking at difference between two quantities. Which quantities are these? We have the standard quantity vis-a-vis what here, the actual quantity, like that. And then we know that for sure, outside here for monetization purposes, we shall be having standard price. But now remember that this is the planning variance that they want us to compute. This is the planning variance which they want us to compute. So then if it's planning, I know planning is original versus revised. So here I'll talk of original standard quantity minus, I'll talk of revised. I can even remove this A. It's supposed to be revised quantity. And then outside, of course, remains. Let me give you 2 minutes to try, and please don't fear getting it wrong. You can't really understand these things without making your hands dirty. We must work. We must work. It's working, remember, that we are doing here. You must work. Just try putting in figures and then we talk. Is there anybody who has any figure there? We compare notes. No, nobody has gotten a figure. I'm still waiting. I'll give you 2 more minutes. We'll start. We'll get back to business at 2:55. 2 more minutes. Don't fear. Let fear not stop you from working. Fear should never stop you from working. If it stops you from working, then you're not courageous enough. So can I do the question? Can I do the question? Can I do the question? Should I do it? Should I do it? Should I do it? Do it. Thank you very much. Great. Great. So let's try again. Let's try this. Let's try this. We watch the video later. Now, remember, this capital SQ, it will be standard quantity for actual production. Whenever I see this, it will be for actual production. Also, this is a revised budgeted figure. So it must be for actual product, for actual production. It must be for actual production. So it means when I look at my original budget, the standard quantity is 10. But this 10 must be multiplied with something. Who can give me this quantity that I should multiply this 10 with? Should be 10 times what? The actual quantity there, 11,000. Minus the revised quantity. The revised quantity is 9.5 times 11,000. And then at the end of the day, I'll be multiplying outside here with the standard price. Can somebody in this case here give me the standard price that I should use now outside here? JS is giving me a figure there. It has to be the very original, isn't it? Whenever you see standard price outside, it must be the very original. So times 5 you'll write. Times 5 you'll write. So see whether my friend here JS was able to get the correct thing. JS seems to be having the correct thing. JS seems to be having the correct thing. 27,500 favorable. 27,500 favorable. Is there anybody who was able to get this figure? Is there anybody who was able to get this figure? Is there anybody who was able to get this figure? Nope. Great. Great. We shall overcome. We shall overcome. So that now marks the end of this planning and what here? Operational variances. But from the look of things, I need to repeat this. I will need to repeat this by looking at another question here. Let's look at another question. Hope, do we have another one? Do we have another one? Do we have another question here? Really? Do we have another question? Where is example 2? Yes, it's here, example 2. So I would want you to try, this is labor, rate, and efficiency variance. And I'm interested in the planning and operational aspects only. The planning and the operational aspects only. So again, sorry for giving you very many questions today. I'll give you exactly 5 minutes. 5 minutes. You try, in this case here, 5 minutes. You try this. We see whether you'll be able to get labor rate planning and labor rate operational. Labor efficiency planning and the labor efficiency operational. Only 5 minutes. Let's compare notes. Please remember, it's about courage. Courage is about saying no to fear. What are you fearing? I'm not even able to see you. I've never even seen your face. Nobody has ever seen each other's face. Even me, you've never seen me, only you see me on video. So no fearing anything. Shout your answer, put your answer down without fearing anybody. Let's see what they have. Let's see what they have. No, they haven't done. They haven't done. So the first thing that I'll do in this kind of a question, ladies and gentlemen, is to tabulate my data. I have to come and tabulate this data. So I must come here and tabulate the data because I'm seeing that there are revisions there. The revisions there, it must be this planning and operational variances that they would want me to compute, It must be the planning and operational variances that they would want me to compute. Great. So I'll come and basically I'll come here. I will come here. I can see they have given me the original budget. So the original budget, this is about labor. So original budget, I can see labor. It is 8 hours. It is 8 hours, each at 4 per hour. And then we have the revised there, right? And then we have budgeted production, sorry. Under the original, we still have budgeted production. We still have budgeted production of 20,000 units. 20,000 units. And then now we'll go to the revised. The revised, what are they telling me down here? Since preparation of the budget, the price per hour had increased to 4.1 and the time had been revised to 7.5. So remember, anytime you want to get labor, you always take hours times rate. So the hours are 7.5 hours, and they are saying that the price is now new. The price is new. Each hour, the price is new. They've told us that the price is 7.5. No, the price is 4.1. The price is 4.1. The price is 4.1. So at 4.1 per hour. Great, great. And then the actual results have been given. The actual results have been given. Straightforward, really. The actual results have been given here. Production, the actual production there is 24,000. So the actual production is 24,000. And then we have labor, 190,000 hours. Labor, 190,000 hours. Labor is 190,000 hours for 769. For 769, $500. Now, if I'm the one doing this, I would want to get the actual rate here. I don't like this thing the way it is. I would want to come here and I get the actual rate per hour. Actual rate per hour. So the actual rate per hour, of course, I'll take the total amount we incur divided by the actual number of hours. So I'll talk over 769, 500 divided by 190,000. Could you kindly give me this figure? 769, 500 divided by 190,000 for me to get the cost per hour, the actual cost or the actual rate per hour. Let me see whether you're getting a beautiful figure. I hope we shall get a beautiful figure. Yeah, that's quite beautiful. Did you round it off or it came just like that? You round it off or it came just like that? Like that 4.05 per hour. I really want to have it like that. Thank you so much. Now from there, if I'm the one, I appreciate the fact that these two, of course, we are talking of planning. And then these other two, we are talking of what here, somebody? Operations. You can start with any, but operations is normally easier. Operations is easier, ina mambo mengi. So kama mimi, nakuja naandika title, na muandikia hapa operational variances. Na sasa sababu hizi ni labor ni aina mbili variances. Tuko na labor rate variance and labor efficiency variance. So we begin with labor rate variance. So labor rate variance, what do we have? Is there somebody who remembers the formula of labor rate variance? Labor rate variance, is there somebody who can remember the formula of labor rate variance? Difference between two rates, what we thought would have incurred while paying these workers vis-a-vis what we actually incurred. So labor rate variance equals what? 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 Is there somebody who can remember the formula? Is there somebody who can remember the formula? Thank you very much. In this case here, they are saying, thank you very much. Anytime we talk of labor rate variance, it is the difference between these two rates, SR, standard rate, minus actual rate. And then outside we have who? We have actual hours. Actual hours paid. Actual hours paid. But now remember one thing, that this person wants you to calculate operational. This person wants you to calculate operational. And this is where the variation is. Here is where you're comparing your two things. So if it's operational, I know so the first one here will be the revised. This will be the revised. This will be the revised. And this, of course, will be the actual. Because operations, you're comparing between revised and actual like that. So who can give me then the standard rate per hour? The revised standard rate per hour. Is there somebody who can see the revised standard rate per hour? Is there somebody who can see the revised standard rate per hour? Anybody who can see the revised standard rate per hour? Please talk to me this afternoon. Talk to me this afternoon. Talk to me. 4.1 is the revised rate per hour. You know, this is standard hours. This is the rate per hour. So 4.1 minus the actual rate per hour. Actual rate per hour. You're able to see the actual rate per hour. Actual rate per hour. Is there somebody who can see the actual rate per hour? 4.05, isn't it? So we have here 4.05. And then outside, we have the actual hours paid. Actual hours that we paid for. At the end of the day, were how many hours? The actual hours that we paid for. The actual hours that we consumed and paid for. Is there somebody who is able to see the actual hours here as 190,000? 190,000. And then please, you have answers. You can go to the back of that book to be able to see answers, albeit the fact them being organized in a very funny way, but at least you'll be able to see them. So then labor rate variance, operational, will be how much? Please open brackets here, 4.1 minus 4.05, you close, times 190,000. Times 190,000, please give me a figure. Times 190,000, please give me a figure. Please give me a figure. 9,500, favorable. So according to Jamie, it's 9,500 favorable. So that is labor rate variance operational. From there, we have labor rate variance efficiency. Labor efficiency variance. Labor efficiency variance. Labor efficiency variance. So is there anybody who is able to remember? Yes, our Indian friend. Anytime we talk of labor efficiency variance, always remember our Indian friend. Indians are the best in business. And actually in everything, those people are way ahead than us Africans by far. In terms of endurance, in terms of seriousness with life, these guys are quite serious. If you've ever worked with them, if you've ever worked with Muindi, you'll realize these guys are not a joke. So anytime they talk of efficiency, we should always remember our friend, Mr. Shah from the Indian community. Even in terms of religion, if it's prayers, they pray so seriously. So anytime we talk of labor efficiency variance, always remember Mr. Shah. And then outside here, of course, you know, you'll have the standard rate for purposes of what year? Standardization, monetization. And then don't forget that this is supposed to be in full. Anytime you see capital SQ and the capital SH, this is supposed to be standard hours for actual production. Standard hours for actual production. Standard hours for actual production. And don't forget that they want us to compute labor efficiency variance under operations, during operations or operational. So operational, again, I'm emphasizing, ladies and gentlemen, operational, we're comparing revised. We are comparing revised versus what year versus actual there. We are comparing revised versus actual. We are comparing revised versus who? Actual. Revised versus actual. So let's try to really put everything into context and look for this. So could you kindly give me standard hours here from the revised? Are you able to see the standard hours, somebody? Somebody, are you able to see the standard hours? Somebody, are you able to see? Yes. But now remember, because of the fact that these standard hours must be reflecting the actual output. So you must take 7.5, you multiply this with the actual production. Actual production, thank you very much. So take this times the actual production, which is 24,000, minus the actual hours. Are you able to see the actual hours from the column? Actual hours are supposed to be how many? 190,000. So actual hours are supposed to be 190,000 times the standard rate, The standard rate, are you able to see the standard rate, ladies and gentlemen? Please give me the standard rate that I should use. Please give me the standard rate that I should use here. Please give me the standard rate that I should use here. Give me the standard rate per hour that I should use. The standard rate of paying these workers per hour that I should use. Millie tells me, for Margaret tells me, thank you very much. Whenever it's outside, it can never come from the middle. Outside can never come from when they mention, I have to go back to the very original standard. So times 4, like that. So then could you kindly give me the answer now? Lastly, the labor efficiency variance from JES, it's 40,000 negative. So 40,000 adverse. It's 40,000 adverse, like that. It's 40,000 adverse. It's 40,000 adverse. So that is okay. But now remember, whatever you've done is operational variance. So I would want you guys to shift gear very fast and compute for me the planning variances now without getting wrong. Please compute for me the planning variances without getting it wrong. So come there and try your best giving me the planning variances. Go ahead and give me the planning variances. Give me the planning variances. Give me the planning variances. I'm giving you just 1 minute to try your best. Time is up. Anybody who has been able to get even the first one, planning variances for labor. Remember, it's the normal labor rate variance and labor efficiency variance, but now this time around, comparing different things. Great. I can see some 19,000. Let's see. I'm so happy. Let's see labor rate variance, but this time around planning. Let's see. Labor rate variance, but this time around planning. So then, ladies and gentlemen, it's a rate variance, two different rates. So we have the standard rate and the actual rate, and then we have the actual hours that were paid. Thanks. But now remember, in the planning, we have budgets being the tools of planning. So remember, in planning, the standard rate here, we are comparing these two. So this has to be original vis-a-vis what here? This must be the revised. This must be the revised rate. The revised rate. So ladies and gentlemen, this is what I shall have. My original standard rate is what here? My original standard rate per hour is 4. Minus my revised rate. Don't talk of actual, just to guide you. So it's the revised rate. Revised rate is 4.1. Multiply outside here with the actual hours paid. Don't look for actual hours paid here. It has to be the outside. It has to be there. So actual hours are paid were 190,000. So could you kindly give me this figure? What are we getting? Fatima, leo umenyamaza sana, Fatima. Today your silence is so deafening. And I'm so sure why, because Fatima and many of you never watched my video. Remember, special revision is a class that I've taught for so long. And how do we do it? You guys will never get a chance of revising again. What we do, we normally go to, if it's variances question that came last semester, we do that question first. After I do it, then I will go straight away in depth to the variances topic. So you look at what if this time around they twist this variances, because like this time around, I've told you guys cannot run away from this. And the planning is worse. Planning is worse because planning and the operations is worse because very many students will not even write anything. But at least I've seen you guys have an idea. So it's important we capitalize on this. So the special way, the way to go, like the video I gave you guys must watch to get proper grounding. And then I'm happy the way you guys are contributing. You like the subject so much. So wanasema the final answer inafaa kuwa 19,000 negative, which is adverse. 19,000 negative, which is adverse, like that. Then we go to the last one, which is labor efficiency variance. Anytime they talk over efficiency variance, I should always remember my guy. In this case here, I should always remember my friend, Mr. Shah. These guys are efficient in terms of business. They're more organized, very organized. Actually, if Mr. Shah today was to come for my sister, I don't think I'll refuse. So anytime they talk of labor efficiency variance, ladies and gentlemen, always remember in brackets here, we have got what here? A Mr. Shah, like that. And then outside, we have the standard what here rate. Let's see whether Millie has gotten it. So remember, labor efficiency variance, this is planning. And for planning, what are we looking at? We're looking at, it has to be the original standard hours here versus the revised hours. Original versus revised hours. So then, ladies and gentlemen, what we shall do here, remember capital SH again is for actual production. Never forget this. For actual production. So then the standard hours, the original standard hours are 8, but times the actual production there, which is 24,000. minus the revised hours. The revised hours here are 7.5. It must always also be modeled on the 24,000. 24,000 into the standard rate. The standard rate, can somebody give me the standard rate to use here? Can somebody give me the standard rate to use here? Can somebody give me the standard rate to use here? The standard rate to use. Jamie says 4. I like this class, Jamie. We have Margaret, they are confirming that the standard rate cannot come from, it has to be the original, so it's 4. Let's see whether Millie got this figure correctly. 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 She says 400 something. So remember your opening brackets here, this times this. Oh, she got it correctly. What do you mean? She got this correctly. Congratulations. 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 It's coming a different figure and I've thrown my congratulations up there. 48,000. Is that what she got? Is that what Millie got? Is that what Millie got? Is that what Millie got? Yes. Great, 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 great. 48,000 positive, favorable. So I want you to do me a favor, ladies and gentlemen. I want you to do me a favor. The favor is quite little. I want you to go back to that video. That is the basic video which you're supposed to watch and appreciate. And then number 2, today's video, you must also watch it in full. Don't assume you have known this one. You must watch it in full. And then number 3, if possible, if you get time over the weekdays, because you have the answers, I would want you to come and repeat this concept that we did with you here. This concept here. This one here is total sales margin variance. Analyze it into sales price variance, sales mix variance. I would want you to do this example 4 from this book. Of course, it can't be repeated this semester, but just for purposes of ideas and expanding our memories, I would really want us to do what here? I would really want us to look at this. I would want us to look at this.